Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate filings. And today we have a doozy from STANDEX International Corporation, a company that has been quietly making moves. We're diving deep into their latest quarterly report to figure out where they stand and what it means for their future. Get ready for some numbers that might surprise you. Before we get into the nitty-gritty, if you love getting these kinds of direct insights without all the corporate jargon, make sure you are subscribed to the channel. And hey, we have a fantastic community over on our Discord server linked in the description below, so come hang out with us. Alright, let us kick things off by looking at where STANDEX stands financially. Their balance sheet from the 30th of September 2025 shows they have total assets of about $1.55 billion. That is a big number, but what is more interesting is how their assets and liabilities have shifted. Specifically, their current assets are sitting at $487 million, while their current liabilities are a bit lower at $169 million. This generally means they have enough short-term assets to cover their short-term debts, which is a good sign for immediate financial health. Now let us talk about cash coming in. Their accounts receivable, which is money customers owe them, stands at $166 million. That is a decent chunk of change. But look at this. Their inventories have crept up to $135 million. This could mean they have a lot of product ready to sell, which is good if it moves fast. But if it sits too long, it can tie up valuable cash. On the flip side, their stockholders' equity, a measure of what the owners actually own, stands at $707 million. This is a strong number, showing a solid base of ownership value even after accounting for things like treasury stock. Now for the heart of the business, the income statement. For the 3 months ending the 30th of September 2025, STANDEX reported net sales of $217 million. Now that is a significant jump from $170 million in the same period last year. That is a 27.6% increase. So what is driving this massive sales boost? Well, the report clearly states that acquisitions accounted for a huge $45.3 million of that increase. This tells us STANDEX has been busy buying other companies. But it is not all about buying companies. Their organic sales, the sales from their existing businesses, also grew by $1.0 million or 0.6%. This might seem small, but in a tough economic climate, even a little organic growth is something to celebrate. Let us look at profitability. Their gross profit margin, the money left after they pay for the cost of making their products, increased from 41.1% to 41.6%. This is a small but positive movement. It suggests they are either selling at better prices or managing their production costs more efficiently, or a bit of both. However, their selling general and administrative expenses also went up. They spent $54.4 million on these costs in 2025 compared to $43 million in 2024. This increase is largely attributed to those recent acquisitions and higher administrative and research costs. So while sales are up, the cost of running the business is also climbing. This brings us to their income from operations. It jumped to $29.6 million from $24.1 million. That is a solid 23% increase. This shows that despite the rising expenses, the growth in sales is more than making up for it at the operational level. Now here is a number that definitely caught my eye. Their interest expense for the quarter was $8.9 million. That is a massive increase from just $977,000 in the prior year quarter. This is likely due to the debt taken on for those acquisitions we talked about. Taking on more debt means paying more in interest, and that can eat into profits. On the tax front, their effective tax rate changed from 21.4% to 24.6%. The report mentions a few factors influencing this, including benefits from equity compensation and changes in where their earnings come from. Looking ahead, STANDEX has a substantial backlog of orders. Their total backlog stood at $302 million as of the 30th of September 2025, which is up from $206 million the previous year. This indicates strong future demand for their products. And guess what? Much of that backlog growth is also thanks to acquisitions. Acquisitions added a significant $55.5 million to their backlog. Their organic backlog also grew, but not by as much. Let us break down how each segment is performing. The electronics segment saw a huge 42.2% increase in net sales, reaching $110 million. This segment is really benefiting from those recent acquisitions. Income from operations here also surged by 66%. The engineering technologies segment also saw strong sales growth of 45.6%, a big part of which came from their Max Starlight acquisition. However, their income from operations in this segment actually decreased slightly. The report attributes this to purchase accounting expenses related to the Max Starlight deal. In the scientific segment, sales increased by about 10%, but their operating income dipped slightly. Apparently, demand in academic and research institutions has been a bit soft due to cuts in government funding. The engraving segment showed moderate sales growth of 7.4%. What is interesting here is that their operating income increased by an even healthier 12.2%. This suggests they are doing a great job of managing costs and benefiting from past restructuring efforts. And finally, Specialty Solutions saw modest sales growth of about 2.6%. But their operating income took a hit, declining by 18.6%. They are blaming higher tariff costs, which is a recurring theme for many companies. The corporate expenses also climbed by 22.2%. This is attributed to higher staffing costs, including variable compensation and employee medical expenses. Now let us put on our Warren Buffett hat and look at the big picture here. STANDEX has clearly undergone a significant transformation. Their strategy of acquiring companies to fuel growth is undeniable. The sales numbers are impressive, and the strategic focus on higher margin businesses seems to be paying off in some areas. However, this aggressive acquisition strategy comes with a hefty price tag. The massive jump in interest expense is a clear sign of increased debt leverage. While their current assets comfortably cover their current liabilities, the rising debt load is something to watch closely. They are also dealing with various external factors like tariffs and inflation, which are impacting their costs and product pricing. The mixed performance across segments highlights the challenges of integrating new businesses and managing diverse market conditions. In conclusion, STANDEX is a company in transition. They are growing through acquisitions and appear to be strategically positioning themselves in attractive markets. The balance sheet looks sound for now, but the increased debt is a notable risk. Their ability to effectively integrate these acquisitions and manage rising costs will be key to their future success. It is a company with clear strategic direction, but one that needs careful monitoring of its financial leverage and operational execution in the coming quarters. Alright, that is our deep dive into STANDEX International Corporation's latest report. What do you think about their acquisition strategy and the impact of rising interest expenses? Let us know in the comments below. If you found this analysis helpful, give this video a thumbs up and subscribe for more corporate breakdowns. And seriously, go join our Discord community. It is a great place to chat about these topics. Thanks for watching, and we will see you in the next episode of Corporate Decoder.